Proper pricing of intragroup services is crucial to ensure compliance with the arm's length principle while mitigating risks of tax disputes and double taxation. Understanding the arm's length principle. The arm's length principle is a fundamental concept in international taxation that aims to prevent double taxation and ensure fair taxation of multinational corporations. The direct charge method involves the allocation of direct costs to the service provider, while the indirect charge method involves the allocation of indirect costs to the service provider. Understanding the cost base. The cost base is the foundation of the remuneration of the service provider. It is the total amount of costs incurred by the service provider in providing intragroup services. The cost base is calculated by adding up all the costs incurred by the service provider, including direct costs and indirect costs. Direct charge method. The direct charge method involves the allocation of direct costs to the service provider. Direct costs are costs that are directly related to the provision of the service. Examples of direct costs include salaries and wages, rent and utilities, equipment and supplies, travel and entertainment. The direct charge method is used to allocate costs that are directly related to the provision of the service. Direct charge method, a pricing strategy for specific services rendered. Direct charge method. The direct charge method is a pricing strategy used in various industries, including healthcare, finance, and education. This method involves directly charging clients for specific services rendered, where the costs can be easily identified, quantified, and linked to specific group enterprises. Key characteristics. Specific identification of services. The direct charge method involves identifying specific services rendered to clients, making it easier to track and quantify costs. Quantification of costs. The costs associated with these services are quantified, allowing for accurate billing and financial management. Direct linkage to group enterprises. The costs are directly linked to specific group enterprises, making it easier to allocate resources and track financial performance. Example example. For instance, a hospital may use the direct charge method to bill patients for specific medical services, such as surgeries or consultations. The costs associated with these services can be easily identified and quantified, and the hospital can directly link these costs to the patients who received the services. Indirect charge method. The indirect charge method is another pricing strategy used in various industries, including healthcare, finance, and education. This method involves allocating costs across all potential beneficiaries, rather than directly charging clients for specific services rendered. Key characteristics. Allocation of costs. The indirect charge method involves allocating costs across all potential beneficiaries, making it easier to distribute resources and track financial performance. Indirect linkage to group enterprises. The costs are indirectly linked to specific group enterprises, making it more challenging to track and allocate resources. Allocation keys. The allocation keys are a crucial component in the allocation of the service. They are used to determine the allocation of the service to the users based on their usage patterns. The cup method involves comparing the price of a similar product or service sold to an unrelated third party to determine the arm's length price. This method is often used for goods and services that are easily comparable to those sold to unrelated parties. Cup method. The cup method is a widely used transfer pricing method that involves comparing the price of a similar product or service sold to an unrelated third party to determine the arm's length price. The key steps involved in the cup method are: identify a comparable uncontrolled price, cup, for the goods or services in question. If the intragroup service fees are not comparable to a cup, the arm's length nature of the fees cannot be tested using these methods. Understanding the arm's length nature of intragroup service fees. The arm's length nature of intragroup service fees is a critical aspect of financial reporting, particularly in the context of consolidated financial statements. Intragroup service fees refer to the fees charged by one group entity to another group entity for services rendered. These fees can be complex to determine, as they often involve a range of factors, including the cost of providing the service, the value of the service provided, and the arm's length nature of the transaction. The cost plus method. The cost plus method is one of the most commonly used methods to test the arm's length nature of intragroup service fees. This method involves comparing the gross profit markup of the intragroup service fee to that of a comparable uncontrolled transaction, CUP. The challenges of benchmarking in Malawi. Malawi's domestic law has not adopted the simplified fixed markup approach, which has led to challenges in benchmarking. The lack of a standardized benchmarking framework has resulted in inconsistent pricing practices among service providers. The absence of a clear and widely accepted benchmarking framework has made it difficult for taxpayers to determine the fair market value of services. This has led to disputes between taxpayers and tax authorities over the pricing of services. The lack of transparency and consistency in pricing practices has also made it challenging for taxpayers to make informed decisions about their tax obligations. The importance of robust benchmarking studies to justify the pricing for services. Taxpayers in Malawi are required to conduct robust benchmarking studies. These studies involve analyzing market data and industry benchmarks to determine the fair market value of services. The goal of these studies is to provide a clear and objective basis for pricing services. By conducting thorough and transparent benchmarking studies, taxpayers can demonstrate the fairness and reasonableness of their pricing practices. In some jurisdictions, the withholding tax rate can be as high as 30% or more, which can significantly impact the service provider's profit margins. Understanding the impact of intragroup services on withholding tax obligations. The complexity of intragroup services. Intragroup services refer to transactions between related parties, such as subsidiaries, parent companies, or branches of the same group. These services can include a wide range of activities, such as financial services, such as loan repayments or interest payments, management services, such as consulting or administrative support, intellectual property services, such as licensing or royalties, supply chain services, such as procurement or logistics. These services are often provided to support the operations of the group, but they can also be used to transfer income or assets between related parties. The risk of withholding tax obligations. When intragroup services are provided, the service recipient, the party receiving the services, may be required to withhold taxes on the income or assets transferred. Introduction. The world of international business is fraught with complexities, and one of the most critical aspects is navigating the intricacies of transfer pricing. Transfer pricing refers to the process of determining the prices at which goods or services are transferred between affiliated companies within a multinational corporation. This process is crucial as it affects the corporation's overall financial performance, tax liabilities, and compliance with international regulations. In this article, we will explore the key aspects of transfer pricing, including its importance, methods of determination, and common pitfalls to avoid. We will also examine the implications of transfer pricing on financial arrangements and transfer pricing implications. The importance of transfer pricing. Transfer pricing plays a vital role in the financial performance of multinational corporations. The prices at which goods or services are transferred between affiliated companies can significantly impact the corporation's overall financial performance.